Never take the wrong fair value gap again. Have you been struggling with ICT's concepts, especially the 2022 model? Well, in this video, we'll show you how you can never take the wrong fair value gap again. We will go over how to wait for the right setup and what indicators to use to help you spot the right fair value gap and never take the wrong one again. We use the MACD to help us filter out the fair value gaps that we want to take. The settings for the MACD are the fast EMA period of 3, the slow EMA period of 10, the signal SMA period of 16. And you'll want to use the MACD lines and histogram. The times you'll want to trade are of course during the ICT kill zones. The London Open, 2 a.m. to 4 a.m. Eastern Standard Time. The New York Open, 9:30 a.m. to 11 a.m. Eastern Standard Time. End of New York lunch, 2 p.m. to 3 p.m. Eastern Standard Time. And we use the 5-minute chart for the best results. When price takes liquidity, look for a swing high to be broken for longs with displacement. For shorts, you want a swing low to be broken with displacement. Confirm the displacement with the MACD lines. The main line is above the zero and the signal line for longs. The main line is below the zero line and the signal line for shorts. When you see a fair value gap form, wait for price to retrace into that fair value gap to at least the 50% level. For a bearish trade, once the retracement candle closes below the 50% level, see if the MACD histogram is red. For a bullish trade, once the retracement candle closes above the 50% level, see if the MACD histogram is green. If so, then this is a legitimate fair value gap. The reason this works is because there is a divergence in the MACD histogram from the movement of price. Let's take a look at a few examples. This is a textbook example. Liquidity was taken, and we now have a liquidity target. Displacement has happened with a break of structure. This is confirmed with the MACD lines, where the main line has crossed the signal line, and then it also crosses the zero line. We are also in a green histogram, and price retraces into this fair value gap. It passes the 50%, but then closes above the 50% level. This is your entry. Price then continues on to take liquidity, and this would be your exit on this candle. The next few examples will have something you'll need to watch for, and we'll have some tips for you to be able to tell which fair value gap is the one you should take. In this example, we have our liquidity zones. This liquidity was taken, and this is our target. Price displaces to the downside. This is a break of structure with this swing low. Price broke that swing low here. There's also a fair value gap. Price reaches right back into the fair value gap, but closes below the 50% level, and it also closes outside of the fair value gap. This is a very important distinction. You want to pay attention to when the candle closes outside of the fair value gap. You'll see the main line crosses the signal line here and goes below zero here. That is our displacement. And the red histogram is where you'll see the retracement happen into the fair value gap. Normally, if price would be going to the upside, you'll see a green histogram, but this one stays red. And that is our entry. and our exit is below our liquidity right here. In this example, we see liquidity taken on the upside. Then during the New York session, price displaces to the downside. Now, some might say this is a displacement, but there was no swing low that caused a break of structure. This right here is your swing low, and price displaces to the downside. It took out both this swing low and this swing low. And here is where the main line crosses the signal line and the zero line. That is your displacement. Then price creates a fair value gap. Now this is where you want to pay attention, because price moved outside of the fair value gap, which in some instances negates your trade. However, price moves back in and then closes outside of the fair value gap. This could be your legitimate entry because of the retracement where there's a red histogram. However, you can also enter here because price closes below the 50% level of this fair value gap. And there's only one green histogram bar. And also a swing high has been created with a candle that has two candles to the left and to the right that are lower. So here's where you have to add a little bit of information and knowledge of ICT concepts to be able to be confident in this trade panning out. And price moves to the downside and takes liquidity, and there's your exit. That same day, after New York lunch, another setup happens. You see a displacement to the downside after liquidity was taken. Price crossed the signal line and the zero line. And this is where we have to pay attention. This retracement back into this fair value gap doesn't reach the 50%. And there is one green bar. Now that might discourage you from taking the trade, but if you want to make doubly sure that price is going to continue to the downside, you'll want to let price form a swing high. And instead of entering on this candle, you can enter on this candle because it closes outside of the fair value gap and it has created that swing high with a candle that has lower candles to the left and to the right. This is also another confirmation with this candle moving into the fair value gap being a bullish candle when the MACD histogram is red. Price continues down towards the liquidity target and your exit is once liquidity is taken. So the quick tips that we have are wait for the next candle to close below the retracement candle to make a swing high for shorts, or close above the retracement candle for longs. Also, if price closes outside of the fair value gap on the retracement candle, then you don't need to wait. We hope you enjoyed watching our video, and please like and subscribe for more videos like these. If you have a question or comment, please post it in the comments section below. Thank you for watching.